You know I invest heavy into ETFs, and specifically my new 3-fund portfolio that's taking over the investing community by storm since it absolutely crushes anything out there. But I do also invest a portion of my portfolio in a couple individual stocks. These are the top 5 individual stocks that are in my portfolio, and I'm going to explain why I picked them in the first place, how they're doing now, and what I think they're going to be doing in the next 5 to 10 years. One of these stocks grew by over 60% last year, and 3 of them beat the S&P 500. Now, you know I like to get some community involvement, so I'd love it if you would go ahead and throw down your top 3 stocks in the comment section and maybe even explain why you like them or which one's your favorite. I'm definitely interested to see how many of us have similar picks. I'm Nolan Govea, my students call me Professor G, and I made this channel to make investing simplified. Now, it's no secret that investing in individual stocks is way more fun than investing in ETFs because individual stocks have a chance to make you super rich very quickly. Had you chosen Nvidia at the beginning of 2023, you would have tripled your money in 1 year. If you would have bought Meta at the beginning of 2023, you would have seen a return of over 178% in 1 year. Not to mention Meta just went crazy the other day, so you'd be looking pretty good right now. Now, because I am a professor and I feel like I do have an extra duty to keep you guys safe, I just want to make sure and mention that investing in individual stocks is definitely more risky than investing in ETFs. If the one stock that you're investing in has a bad couple of months, that could absolutely ruin your finances, so just be careful on that. Had you invested in AMC stock in 2023 because you figured the pandemic is over and people are getting back to the movies with life as usual, you would have lost a whopping 83%. $10,000 invested in AMC would be worth less than $1,700 today, so be careful. Just like the fact that I invest in pretty safe ETFs, my individual stocks are pretty safe picks as well. But I do have a couple of my picks that are a little bit more risky, especially today. And so these ones are a little bit higher risk, but possibly super high reward. I'm gonna list them in the order of size within my portfolio. First up, my number 1 biggest position in individual stocks is none other than Microsoft. And I've talked a lot about Microsoft on this channel. You all know what Microsoft is. But here's a couple of things that maybe you don't know. Most people choose it for its high status in the tech world and its brand equity, but I chose it in the first place due to its incredibly healthy balance sheet. A tech firm is not supposed to have such a beautiful financial statement. Microsoft is now the biggest company in the world, beating out even Apple, and it's super high growth with no end in sight, but it's set up almost like a bank with some of the safest financial statements in the world. This takes the risk way down for investors. Today it has a price of $403.89. Year to date, it's up almost 9% already here at the beginning of February. Over the past 5 years, it's up a crazy 293%. Microsoft has a market cap of $3 trillion, making it one of only 2 companies in the world to hit that. The PE ratio is 36.52. and the dividend yield is 0.74%. Now, that dividend yield is not a crazy high number, but when you think about how much that price appreciation happens with the actual stock price, and then you know that that dividend is just a percentage of that, as the stock price goes up, that means that dividend yield is going to be a lot of money at some point. Microsoft has also increased its dividend regularly over the past 10 years, often at an annual rate of 10% or better. Obviously, Microsoft is deep in the AI game and is going to be the market leader in that, and many other tech spaces, so I just think this is a lock for the foreseeable future, and I continue to add to my position every single month, just dollar cost averaging. Next is a company that goes a little different of a direction than just tech. Like I said before, I definitely like to pick safer options, especially if I'm investing in this riskier option, which is the individual stock. I like to follow the lead of those who do ample research, have a solid investing strategy, and who have a cool, calm, and collected temperament. So I definitely like to follow one of the best in the business, Warren Buffett. His company, Berkshire Hathaway, is one of the only companies to consistently beat the market year after year, And the reason I like investing in this company is because it differentiates my portfolio well into things I wouldn't normally invest in. My second biggest holding is Berkshire Hathaway. Berkshire Hathaway is a holding company for a multitude of businesses, including Geico and Fruit of the Loom. It owns a variety of well-known private businesses and has a significant minority interests in public companies such as Apple. Greg Abel is the heir apparent to Berkshire CEO Warren Buffett, who in his 90s has yet to announce any plans to step down. The biggest gripe that I hear from people about investing into Berkshire at this point is the idea that Warren Buffett is getting very old, and so what's going to happen to the stock or the company when he passes on? I've read more than 10 books on Warren Buffett. I've read everything he's had to say, and I've listened to all of his speeches. He's a great investor and businessman, but even more than that, he's an incredible leader. He has been setting up this company and the heir for years for a very smooth transition, and I'm not worried about that at all. Berkshire has a current price of over $384 today. It's up over 6% this year to date. Berkshire's up almost 84% over the past 5 years. It has a market cap of $834.66 billion. The PE ratio is nice and low at 10.99, which is incredibly attractive for value investors. It famously has no dividend, but the price appreciation yearly speaks for itself. One of my favorite things about Berkshire Hathaway and Warren Buffett in general is that he runs this company so safe and keeps so much cash on hand. As of the end of last year, there was more than $150 billion just sitting there ready to be used on investment. When they find a gem, they go in hard, which is amazing for us investors to reap those rewards. Berkshire Hathaway is by far one of my favorite companies, and I'll be holding on to this one for life. Next up in my portfolio is one of the first companies that I ever invested in, and it's probably one of the first ones you ever invested in as well. They have products that most people could not live without. They have an even better business model and an amazing management team. They pride themselves on innovation and finding the next big thing in technology, but also by keeping things incredibly simple and user-friendly. And we like simple around here. Apple, just like Berkshire before, is not just one of the biggest companies in the world, it's also one of the most profitable, which is the most important for us investors. It turned last fiscal year's revenue of $383 billion into net income of $97 billion. It's also got a little over $60 billion worth of cash or highly liquid cash-like holdings on its book. So just like Berkshire and even Microsoft before, Apple has a bunch of cash just sitting there ready to be used for research and development and to increase its lead on competitive advantage in their space. Apple's up 348% over the past 5 years, which is even higher than Microsoft. It has a market cap of $2.88 trillion and has reached $3 trillion recently. The PE ratio is 30.41. It has a dividend of 0.51%, which again is low, but with that price appreciation that's expected to have long term, that dividend is just icing on the cake. Apple is here to stay with an amazing CEO in Tim Cook, great leadership team, and great long-term projections. The next two largest individual holdings in my portfolio start to get a little bit dicey. Those first three are arguably some of the best companies that anybody could invest in forever, pretty freaking safe, and there's not much to worry about there, and are gonna have some super high growth. These next ones are down in price. They have a bit more risk because they're a little bit shaky as far as figuring out what's next for them. But traditionally, when you buy a stock, it's better to buy when it's down, because then when it goes back up, you're just gonna make that much more profit. So this next one on my list in number 4 is one that I get a lot of flack from just because the company is going through some things and they're quite loud about their political beliefs. And I don't necessarily agree with everything that this company has done as far as the direction and where they're going with their products and services. But as a purely numbers investment and believing in their management team, I do like this as an investment. This company is Disney, and it's led by All-Star CEO Robert Iger, which again, many people criticize, but the man is a genius and one of the hardest working CEOs to ever do it. The company stock is down big over the past couple years, mostly due to the streaming business and the amount of debt associated with that. We have to remember that they totally changed up their entire business model because they understood that digital is the way of the future, And so they had to invest big in this and go hard. This obviously had a huge cost, definitely started negative, which definitely brought down the price of the stock. It made sentiment super negative for the company, but everything is starting to trend much more profitable, and it might even break even by the end of this year. And once that happens, expect Disney stock to shoot right back up, because even though digital is a big piece of their business, it's not even the only thing in their business. As far as their theme parks, average revenue per daily guest is 40% higher than it was in 2019. Disney announced in September that it will roughly double the capital expenditures for its theme parks, cruise lines, and other experiences to $60 billion over the next 10 years. With Disney's experiences segment accounting for 37% of the revenue in fiscal year 2023, but 70% of the operating profit, it's easy to see why it's investing heavily to build on that success. Disney has a current price of almost $97. It's up almost 7% this year to date, but it's down negative 12.88% over the past 5 years. So this is a nice place to be to scoop up shares on sale. Disney has a market cap of $177.86 billion. The PE ratio is 75.38, and the dividend is 0.31%. Those last two numbers were not great. I'll tell you, I have not been adding to my shares over the past year, and that's because I've been watching this company. I didn't really know what direction they were gonna go. I definitely didn't sell my shares because I do believe they're gonna figure it out, but I wanted to see exactly what the strategy was and where they were gonna go with all of this. I do like what I'm seeing recently. I know that this brand is incredibly sticky with lifelong fans and incredible competitive advantage. So this is the type of company that I definitely want to hold long term. Now this last one on my list is definitely the most risky. Like risky. Like be very careful and most of you should not invest in this stock. Risky. Then again, it probably has the highest upside of the 5 that I listed today. So pick your poison. When I was finishing up my MBA, I was reading everything I could on one of the world's largest economies in China. I just understood with the sheer amount of people in that area that a company that absolutely crushes it out there could do very, very well as an investment. At the time, there was a company that was absolutely dominating everybody else, and not just in China, all in the East. This company had an all-star founder and CEO in Jack Ma. This company is called Alibaba, and in my opinion, it's one of the biggest and best companies in the world, but the Chinese government absolutely obliterated it. In the US, if a company gets too big, the government can come in and try to level the playing field a little bit and can make it tough if you're trying to monopolize or anything like that. But in China, it's a whole different story. Whatever the government wants to do out there, they can do. So the reason this is such a risky investment is because out of nowhere, their government can just shut it down or cut it in pieces, and it makes no rhyme or reason. The Alibaba revenue model is highly diversified with income derived from various sources such as e-commerce, cloud computing, digital media, and entertainment. It has the chance to be bigger and stronger than Amazon and was trending that way about 3 years ago when I bought in heavily. Recently, Alibaba has been making headlines with all sorts of good news and finally growing in share price. Whenever I see high-profile business people or the business itself making big rebuys of the stock, I know they know something that we don't. Alibaba stock jumped this week on reports that co-founder Jack Ma and his business associate have been buying shares of Baba stock in recent months. According to an SEC filing, Say purchased $151 million in Alibaba stock in the fourth quarter, and Ma bought $50 million worth of Alibaba. Almost all big stock professional firms are rating Alibaba a buy in 2024 due to the fact that it's so lowly valued, so the risk is much lower at these prices. But then this company is absolutely massive with quite an infrastructure, so if this thing were to get back running on all cylinders, it could absolutely crush it and your investment could super grow. Alibaba has a current price of $72.43 and it has a market cap of $184.22 billion. It's down about 3% this year to date, and Alibaba's down big at over negative 50% over the past 5 years. Alibaba is a very high risk but possibly high reward stock, so please do your research. Watch this video next to continue your financial education and to get you to that financial freedom faster.